Hello and welcome to the DIY Investing YouTube channel. We're working through every company in the S&P 500, and today is Exelon Corporation, ticker EXC. Over the next few minutes, I'll discuss my thoughts about the valuation of this company and its business quality. Market cap is $42.8 billion, enterprise value of $78.1 billion. So you can see about $36 billion in net debt on this business. It is an electric utility company, so that's not uncommon, but $36 billion is almost half of the enterprise value. It is a very significant amount of the business here is basically being funded by debt. That's probably more than the overall net equity in the business from a business balance sheet standpoint, even though the market cap is larger than that. So very significant amount of the enterprise value through debt. They are a utility services holding company engaged in energy generation, delivery, and marketing in the US and Canada. So it's nuclear, fossil, wind, hydroelectric, biomass, and solar generating facilities. So all across the gamut of production. They sell to wholesale retail customers. Purchase of regulated retail sale. And they have transmission distribution of electricity and natural gas to retail customers. So useful to know. So they are a generation company. They are producing the electricity themselves. They're also distributing it. They have both of those sets of lines. They are headquartered in Illinois. So I'm going to assume they're primarily serving areas in the northern United States and Canada through their business here. So you see beta 0.61, relatively low beta. The lower the better, tends to be a little bit more stable. But when I look down at this return on invested capital chart, that's not exactly what I see here. It actually looks like it bounces around quite significantly in terms of the return on invested capital. So it's not nearly as stable as that beta number would suggest. One of the things here is this: they are generating electricity, which means depending upon how much exposure they have to, say, fossil fuel prices, they're going to have this exposure in terms of the change in their raw material cost. That's one reason you might see such big bouncing around, which is kind of a downside in terms of their overall performance. One thing that's interesting is it's not often that a utility company is able to get a return on invested capital above 10%. And you can see that they were basically above 10% for 4 years, certainly 3 years of the last 20. But their performance since 2012 has been quite poor, basically averaging 3 or 4%. You can see this 10-year median return, 3.5% return on invested capital. This is simply too low. This 5% line here is kind of capping the recent returns over the last decade, and you never really see them get above that but once in 2017. In addition, they don't have the benefit of being stable, and the lack of stability means that it's really hard for me to predict the future. What is the future going to look like for this company? Is it going to continue to bounce around like this? Are we going to have another year like the past where it went from a big return down to a small return? Could we drop even lower than the current 2% returns? 2% return on invested capital is terrible. Not only do you have to think about 2% return on invested capital here, you also think that interest rates have recently gone above 2%. You're in the 3, 4, 5% range. And so now that interest rates have exceeded your return on invested capital, you start to get into a really bad cash flow situation for your business. So I don't like what I see with that sort of setup. The other thing that I'm seeing here is you're continuing to get worse. You are growing your asset base at 9.2%, and your revenue is growing at slower at 6.7%, and your EPS has, it looks like, flipped or gone negative over that period of time. So a major concern that this business won't be very sustainable going into the future. And what's crazy to me is that despite having a return on equity of 6.7%, you're still trading at a price to book of 1.7. Now, I like double-digit returns. In order to get a double-digit return, you need something like a return on equity of 10% bought at book value. When you buy a return on equity of 6.7% and you're buying above book value, it's basically impossible to get double-digit returns based upon the business performance. You can always get it based upon changing stock prices, but in terms of the underlying business compounding, you're not going to see that with these sorts of returns. So how are you growing faster than your return on equity? It's again taking on additional debt. And probably as we dive deeper and we look at the cash flow statement, the income statement, we're going to see the use of growing debt, the use of issuing shares in order to fund this growth, because you're not able to do it with the actual returns of the business. The PE here of 20 is just simply way too high for these sorts of returns. You'd want to buy this company at a PE of I don't know, 10 or less, because you need to take into account future dilution that's funding your growth, your poor returns on capital here. You're really going to get most of your return here from your dividends, which means it's not even about the price to earnings ratio per se, but what your dividend yield is. You're going to want a very, very high dividend yield, probably 6-8% plus in order to justify purchasing this company. But let's dive on deeper. So you see revenue 23 billion grew to 36 billion. So you basically 50% more revenue over the course of the decade. That's decent performance. I don't know why it's saying negative EPS growth. You did grow from $1.42 EPS to $1.74 EPS. So you did grow, but it's basically only 20 or 30% growth in the EPS number. That is lower than your revenue growth number. And again, that's kind of a sign of negative operating performance, worsening returns on your capital. All of those things are showing up in these numbers. You are getting a dividend. And what's crazy is this dividend sometimes exceeds your EPS. It's bouncing. It's not a stable dividend. Certainly, it does bounce around a little bit. You're using a lot of cash flow for dividends, and yet you're still growing. And basically, I'm going to see that this is not going to have the ability to do that without some like Ponzi-like features, which I think we're going to go into in the income statement. If you're enjoying this video, hit that like button. Don't forget to subscribe. And at the end of the video, I have a link to the playlist showing my best and favorite companies in the S&P 500. I think you will enjoy those stocks, even if this one is more of a learning experience. So automatically, the first thing I want to look at is the shares outstanding here at the bottom on the income statement. You can see this basic shares outstanding went from 819 million diluted shares outstanding to 980 million. You've basically increased your shares outstanding by 30% over the course of the last decade. Maybe it's not 30%. Let's call it 20%. So 20% more shares outstanding. You're basically going to put like a 2% per year damper on your CAGR in this business than you would have otherwise had. I mean, you see that the net income has basically doubled, and yet your EPS is only up, 30 to 50%. That's partly the drag due to the EPS getting brought down with more shares outstanding. They're having to issue more shares outstanding because they cannot self-fund their growth. That's one of the reasons why looking at these returns on capital are so important, because when you see these numbers, you should not see growth higher than that unless they're able to not fund it internally, and you always want to be buying companies with internally generated cash that they can use to fund their growth. One of the things that's interesting too is you have $32 billion in PP&E at the beginning of the decade, $84 billion at the end of the decade. So that's $52 billion in additional capital brought into the business to fund these purchases. They've more than 2x their PP&E, and that's more than but their revenue only went up 50%. Their EPS went up even less than that. So you're getting worse and worse returns on your capital. Not only that, though, we see you had $52 billion in additional capital, and yet, let's say generously, you've averaged $2 billion a year in net income. So if you say $2 billion for 10 years is $20 billion, where does the other $32 billion come from? It would have to come from debt and, additional issuances of shares. So they are not funding this growth from the business. That's what it tells you. They're not producing that money to be able to do it themselves. They're having to borrow from the future, borrow from other people, all sorts of things like that. You can see the increase in debt here. 23 billion came from debt. Your retained earnings, of course, have gone up. 6 billion here. Common stock has doubled. So again, just showing where they're having to bring on that additional equity in order to do that. Not the signs I like to see here from the balance sheet. Let's go to the cash flow statement. One of the things that I often see with companies with these sort of metrics is you'll see that the investment in PP&E not is simply higher than your net income number, but it also tends to be higher than cash flow from operations. And we do see that here. So in 1 year, 2014, 2 years, 2015, 3, 4, 5, 6, 7 out of the last 10 years, they have actually spent more money on PP&E than they gain from cash flow from operations. That's completely ignoring the fact that it basically means that you're going to wipe out your net income. You're not actually making net income because you're operating at a negative cash flow basis. So cash flow minus CapEx is a pretty good way to understand what the cash flow from the business is, and they're in a very poor setup. Not only that, they're still spending on acquisitions. They don't have the money for acquisitions. And this depreciation number is much lower than what they're doing and from an investment standpoint, which means that they're overstating their net income. They're not nearly earning as much as they tend to be reporting. Basically, they can't pay dividends and still grow if they were lost access to the debt market, lost access to the equity market, which is always a possibility in the future. And so it creates a really bad future situation for them in their ability to perform. Not uncommon for a utility company, but it's why I said at the beginning that I would want a very high dividend yield, because I wouldn't assume I would get any more return from this business than the dividends I receive today. So this is the type of company that I would avoid. I don't like companies that have this setup where you're constantly issuing shares, you're constantly raising debt, and you have negative cash flow because the cash flow from operations can't even cover your CapEx, let alone the money you want to be sending to shareholders through dividends. And you're just taking on more debt, continuing to issue shares. It's not sustainable. So I would avoid Exelon Corporation. But if you want to see the companies that I like, the watch list playlist is up at the top here. And don't forget to like, subscribe. And if you want to learn how to use the same software I'm using, quickfs.net, you should consider signing up through my affiliate link in the description below. It's the first link in the description to quickfs.net. Let them know Trey sent you. Thank you for listening, and until next time, stop paying fees, start building wealth.